Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, joined by my co-host Kevin Hinks. But let's bring in our next guest for our cash tag segment, and that's going to be Landon Swan, the co-founder of LikeFolio. Welcome back to the show, Landon.
Thanks, Tom. Good to be here.
All right, so we're talking Dick's Sporting Goods. Shares are only down slightly so far this year, about 2 or 3%, but it's rallied about over 70% since hitting 52-week lows in May. It was trading down near 63. It's had a good run back. It had a good 2021. Are we seeing any weakness in your data at LikeFolio on this company? Because I don't even know if they're a duopoly. They compete with e-commerce because so many of the sporting goods chains have gone bankrupt or gone away. Sport Mart and Sports Authority.
Yeah.
They've kind of gone away, maybe Hibbett Sports in a regional basis, but they don't really have a peer as far as the brick and mortars go, do they?
Not really. I mean, you could maybe make an argument that you can go to Target or Walmart for some of the things that you might go to Dick's for, but not at the level that they're at. Like if you need something specialized, or your kid's signing up for baseball and you want to be confident they're going to have everything, you're going to Dick's Sporting Goods, not Target or Walmart. And I'll tell you, this company has been on a tear. I mean, if you widen out a little bit on the stock chart and you go back to 2020 pre-COVID, I mean, this stock has over doubled since then, and a lot of leagues were shut down, and yet they did extremely well over the last 2 years. So they are really hanging in there. This is, I like to think of this as a fairly recession-proof industry. I mean, other than truly addictive products like alcohol, cigarettes, and maybe even gambling, this is one of the most recession-proof things, because as a family, it's really pets and kids are the last thing you cut. I mean, if your kid's in a sports league, you're going to get them the equipment that they need. If your pet's sick, you're going to get them that kind of thing. Vacations are going to be cut way before you tell little Johnny's not in the basketball league this year because you can't afford it. So Dick's is hanging in there, somewhat recession-proof, and our data is actually pretty strong. If you look at the blue line here, this is the 90-day moving average of people just talking about Dick's Sporting Goods, either the store or the online, the website or pickup, whatever it may be. You can see here we got a nice little run up over the last few weeks, very similar to last year, a little bit, I think, outperforming that last year. But it's the beginning of a lot of leagues right now, and it's a good time to be invested in this company. They've done very well. The mentions are holding strong. You can see that they dropped off during COVID, but have effectively recovered almost all the way, and they're ramping up right now. So when you look at our data overall, happiness is there, mentions are there, purchase intent is pretty strong. Overall, we're looking at a plus 55 going into this earnings report. And I know they have a long history of doing well on earnings reports, so I think this is likely to be another one where they do fairly well. There's obviously concern just in general. The markets are struggling today. We saw what happened with Target. And even though they don't have a direct competitor, I would think that, Target coming in with weak numbers would be a little bit concerning for Dick's investors. But no, they've kind of shrugged it off, and we're holding here very strong relative to the market. So I do believe the only concern that I have is that expectations could be really high. Like if the narrative among investors, institutionals especially, is that Dick's Sporting Goods is recession-proof and they're fine, and there's no chink in the armor, and don't worry about what happened with Target, all that kind of. If there's any kind of crack in that story, I do think that because of how strong the stock has been, it could be a little bit of a sell-off. I don't think that's going to be the case, but that's my only worry, is that expectations may be especially high going into this report.
Landon, two of the notes that I read before today's show talked about their inventories being at record levels, and $2.8 billion in inventories that they're holding. During the pandemic and during the supply chain problems, they were able to muscle and get a bunch of inventory. Well, now they've got it. And Landon, if you're looking for football helmets and football spikes, and they're loaded up with baseball bats and gloves, we know what has happened in the past when Target and Walmart got inventories wrong, right? They have to discount, they have to maybe cancel other orders. Are you seeing anything of that? You're right, this stock has had a great run, and the Foot Locker data was relatively weak. The earnings were basically in line with the data, but they hired a new CEO and the stock popped. This has a little bit, in terms of your data, a different story, but I'm reading about these inventory levels that if they can't get through this, they either got to cancel orders or they got to deeply discount this stuff, or both. What, are you hearing anything about that, Landon?
Yeah, I agree with you, Kevin. I think that the inventory story is a bit of a gamble, right? I mean, they're basically saying that because of 2020 and all of the supply chain issues, customers were very frustrated, and I was one of them. Sometimes I went to a Dick's or another store, and they just didn't have what I was expecting them to have. They've solved that problem now, and the gamble is that people want these products as bad as they have in the past at that same level. So if they're right, then they're going to do extremely well. They're going to be the place where parents and customers know this is where you can go to get your product. You're all set. If they're wrong, then as you talked about, they're canceling orders, they're discounting, then it's a lot more trouble. So it's really going to come down to that consumer demand. And what we're showing is that the consumer demand is there to support these elevated inventory levels. If we're wrong, if something like that is happening, then I think the stock could be very well punished. It could be ugly, but I don't think that we're wrong. I think that the demand is there to support the higher levels of inventory, and long term, it could be a good strategy considering, turning off customers. If you don't have what they need, they're likely to start shopping elsewhere. They don't have a lot of, direct competition like you talked about, but there's always the internet. You can always find something on the internet if you go to the local sporting goods store and they don't have it. So I think you want to make sure that your customers remain happy. That's priority number one, and get their orders filled. If you have a little bit too much, I'd rather a company err on that side than not enough. But if you're far too much, then you're in trouble. So I think that's the concern that investors will have going into this report. And it's just going to come down to, is the consumer demand there to support these inventory levels? LikeFolio data says it likely is.
So Landon, I'll break down what the hard lines, like golf equipment, fitness equipment, that's about 44% of their business, 34% in apparel, and about 21% footwear. My question to you is, when you look at some of this data, does it give you any indication that, I know golf is hugely popular right now. It seems like that's come roaring back over the last couple of years. Is certain segments within what they provide, because we heard that apparel is starting to come down here a little bit as far as sales goes from some other retailers, is that the key, that they can offset some weakness in one with maybe a higher margin business, like maybe their golf clubs or something like that?
Yeah, I think that, they have a lot of different things going on, which I think is wonderful. They've got, like you talked about, all these different segments where if one's slowing down, maybe people are trying other things. We are getting towards the end of summer, which for most is the winding down of golf season, but maybe you've been playing so much now you're comfortable to buy that new driver. I don't know. But I think we've seen a lot of gyms reopening, people getting back into fitness classes instead of working out from home. That's going to boost apparel and footwear. I don't think, like I talked about with kids sports, I don't think that there's any concern of that going away. You're always going to buy your kids stuff, sporting equipment, that kind of thing. So I think that they've got some things that are going to be steady for them, like the kids sports, and then other things that are going to be more seasonal, like golf. And then hopefully with apparel and footwear, it's going to come back and continue to come back with all the reopening that's been happening. So the data was pretty low when all the gyms were closed. I think people were content just working out in whatever they had at home. Whereas now, if you're going out to gyms, and you got to look the part, right? So you need to look good, get all the new equipment, all the new clothes. So I think it's a great point that you have, that they've got a lot of different channels that can offset each other. As one grows, the other may shrink, and vice versa. So they're diversified, even though they are sporting goods, which there's actually a lot of different areas within sporting goods. Yeah,
that parabolic move, we got the chart up right now, Landon, over the last couple of months, pretty spectacular. But now your data is basically in line with what the price of the stock as far as your mentions go. So you guys are, you mentioned that you're positive on this going into it with your earnings score?
Yeah, we're plus 55, and again, the concern is that it's had such a good run, not only over the last 2 years, but also, like you see, over the last few weeks, really, really strong numbers out of this company as far as the stock price goes. And so expectations, generally speaking, the stock price and expectations, that's the materialization of what expectations are. So high stock price means high expectations. And just the fact that they've kind of shrugged off what the market's done, they shrugged off what some other retailers like Target have done, and they're just kind of holding strong, tells me that investors have very high expectations going into this. So any miss at all as far as not just sales, but also how is that inventory moving or things like that, any hint of a problem, I worry that that could bring down the price as those high expectations are kind of dampened a little bit. So yes, I'm bullish going into this report, but because of the run that the stock has taken, I'm cautiously bullish, even though we're plus 55.
Yep. All right, Landon, good stuff as always. Appreciate it. Have a great day.
Thanks, guys. Take care.
All right, that's Landon Swan, the co-founder of LikeFolio, breaking down the data here, Kevin.